So instead, we're going to create the entire metaverse. There's going to be VR and AR, and everybody's going to be interacting with avatars. And this is all going to happen in 10 years' time. Hey everybody, Walrus here from Walrus Street, bringing you your news and earnings for the week of November 1st, 2021. Just a reminder, I am not a financial professional. All information in this video is for entertainment purposes only. The week in the market is a wrap, and it was a good one. We had the S&P, the Dow Jones, the Nasdaq all closing at record highs. The Russell is chugging along. It's still a bit below its record high, set about 6 months back, but it's trying. And in the grand scheme of things, isn't that what really matters? Oil's coming in around $82 a barrel, and the energy companies are absolutely flying upward. A lot of them gaining 40 to 50% just since August alone. The smaller ones, not the larger ones, obviously. A lot of exciting stuff on the channel. The options series seems to be doing pretty well. I'll be hitting you guys with episode 2 of that video Monday or Tuesday this week, probably Tuesday. Now today in this video, I have an interesting stock idea for you, possibly options depending on how bullish you are, and also I'll be releasing a very short DD video to kind of expand upon something I want to introduce here in this video today, but I don't want to spend like 12 minutes on it in this video, so there will be kind of an addendum to this week's episode. Oh well, good enough. Let's get started with the news. I guess the big story of the week would be Hertz's plan to buy 100,000 electric vehicles from Tesla, and this caused Tesla's valuation to go up over $1 trillion for the first time. The byline, Hertz is going to invest in new EV charging infrastructure as it electrifies its fleet. Full stop right there. If you're like me, you might have read this headline and been like, wait, what? Hertz? I thought they were bankrupt. Well, they were bankrupt. They filed for their whole Chapter 11 nonsense, and they've been actually trading OTC pink slips for a while now. Apparently, they were bailed out by some outside investors who just want to get the company back on its feet. And the interesting thing about Hertz is that they still have a lot of physical assets. They have locations, they have fleets, so those assets are worth something. It doesn't take much other than injection of capital to get the company back on its feet, and apparently the people that are injecting said capital want to create as much buzz as possible, and Hertz is going to become the first rental fleet to go electric at such a large scale. Tesla's valuation shot past $1 trillion on Monday, with the stock closing at a record high. Tesla's stock rallied more than 12%. CEO Elon Musk tweeted wild times with the little 1 trillion in there. Hertz said the initial order of a total of 100,000 Teslas will be made by the end of 2022. The car rental company also said it would invest in new EV charging infrastructure across its global operations in a bid to offer the largest EV rental fleet in North America. Hertz emerged from bankruptcy this summer, saying it was a much stronger company ready to capitalize on the summer's travel rebound and skyrocketing car rental prices amid a scarcity of rentals. Now, the second thing I was wondering when I saw this report is, wow, what kind of discount did Hertz get on all of these cars? And thankfully, Elon Musk, because he just has to tweet everything, answered that question for me immediately. Well, not for me, but for somebody else. To be clear, cars sold to Hertz have no discount, same as the price to consumers. Wow, okay. So there you have it. Hertz is going to be buying 100,000 cars from Tesla into 2022, and it's going to be coming at market cost for the cars, at market price. This is bigger than you might think. Maybe you're thinking, oh, it's only 100,000 vehicles, but what do you think happens when Hertz starts fielding Teslas on the road? Everybody's excited to drive a Tesla. Even if you don't want to own one, I guarantee almost everybody wants to try one, because the acceleration, everything that's associated with the EV, the sleekness of the interior, the intuitive controls, all of that, people want to try it, and one of the ways to do that is through rental cars. Well, you're going to have all of the other rental car companies being forced through this move to add Teslas to their fleets. You're going to have Enterprise, you're going to have Avis, you're going to have Budget. All of them are going to be adding rental cars to their fleet, and that is where the excitement comes in for Tesla. So this is kind of a very forward-looking move up in their price, as with everything else with Tesla. If we take a look at their chart, the last couple weeks have just been legendary for Tesla. Go back to the beginning of October, just the last month, right? The last 20 trading days. Tesla closed at about $7.75 a share, and right now we're sitting at 1,128 after hours. This company, we already had a split. it, and we're already back up above 1,100. The valuation of Tesla is absurd, and the people are so excited, and it's wonderful to see this company succeeding. It's wonderful to see them hitting all of their sales milestones. Next news story, the second largest automaker in the world, Toyota, unveils its first all-electric car, the bZ4X, an electric SUV packed with cool features. Toyota was really pushing the hydrogen thing for a while, and they're kind of giving up on that. Hydrogen is still really expensive to produce and to get the infra all over for hydrogen, and it seems like Toyota wants to start shifting towards EV, and I think this is a kind of an effect of them seeing the effect that Tesla's having. And I know you have to start years in advance, but people can see how successful Tesla is and then want to emulate them. Toyota kind of moving towards the EV, and this is going to be an entire fleet, by the way. The BZ part of this name, bZ4X, BZ is going to be their symbol or their calling card for their EV fleet, and BZ stands for like Beyond Zero or something. I don't really know what they're going with there. But anyway, this is pretty exciting, and the vehicle looks pretty nice. I still think Ioniq is definitely the nicest looking EV crossover, but this is pretty stylish. Yeah, I love the interior rooms on the EVs. They always seem so spacious, and the touchscreen's great. Here's the chassis here. I'm not going to go into the specifics because I'm not really a car person and I don't understand them that much. Oh yeah, here it is. BZ stands for Beyond Zero, and it's going to be their sub-brand for their upcoming electric vehicles, starting with this one. Not much to say financially there. You know, Toyota is the second largest automaker in the world, so them introducing their first all-EV vehicle is a big deal, and I know somebody's probably going to post in their chat that Toyota tried this like over a decade ago. They did release an all-EV Toyota RAV4, and that's been like purged from everybody's memory banks because it was such a terrible vehicle. But, you know, this is their first foray into EVs as it stands. Next news story, Amazon badly misses on earnings and revenue, gives disappointing fourth quarter guidance. Ruh-roh. Amazon missed on both the top and bottom line, and it also gave fourth quarter sales guidance that was below Wall Street's estimates. Now, this is the second straight earnings report from Amazon that is disappointing, and they kind of addressed everything last earnings report, and still people were disappointing, although this one didn't fall as much after the ER. So basically, Amazon's figures were artificially inflated last year during the pandemic when everybody was stuck at home and online shopping was like literally the only thing you can do. But now that people can go back to stores and people are looking for more options, as consumers always do, Amazon has been suffering a bit and coming back down to reality. Earnings were pretty brutal though. It was $6.12 a share versus $8.92 per share expected. I mean, that's effectively almost a 33% miss. And revenue was $110.8 billion versus $111.6 billion expected, so that's another miss. The company's reckoning with decelerated sales growth as consumers go back to physical stores, and there's also supply chain challenges, as we see with everything. And their forward guidance was pretty rough, and this was probably a larger contributing factor for the decline. For the fourth quarter, Amazon forecasts sales between 130 and 140 billion, which represents growth between 4 and 12%, and the analysts surveyed were expecting revenue to rise 13% year over year to 142.1 billion. The company is still dealing with labor shortages, higher employee costs, which we've talked about, global supply chain constraints, and increased freight and shipping costs. Amazon is navigating these challenges as it enters the peak holiday season, he said. So it feels like everything is just coming home to roost. For the last couple of months on this channel, we've been talking about how Amazon is so desperate for workers that they're incentivizing new hires with cash payouts, hiring bonuses, higher wages, and all of that doesn't come cheaply. When you're hiring hundreds of thousands of new workers, you really have to account for that salary. And every new worker is money taken off the net income. So we have a company that's being forced to pay out more for workers. We have a company that's being forced to pay the exorbitant shipping costs. Keep in mind, a container from Hong Kong to New York before the pandemic was running like $3,000 for the transoceanic voyage. Right now, that same container is above $18,000. So this is a 6x increase on just containers traveling across the world. So Amazon really has to struggle with a lot of these logistics increases for their products to ship everywhere. On top of that, we have higher gasoline costs for their truck fleets across America. That's going to affect all of their air fleets. Everything is being affected by the higher costs. And I don't feel bad for Amazon, but them missing on their earnings report, okay, that kind of makes sense given everything that we've seen and everything that we know. Take a look at Amazon stock. This was after their last earnings report. This is where we had that really big drop of of like 8%, 7.5%, 8%. And since then, we've been just trading flat. And actually, after this earnings report, even though it was pretty bad, it wasn't like bad. They ended up losing about 2%. So it seems like this is the range that Amazon's kind of settling into, and we're not going to be dropping below that 3.3 level. There's some pretty strong support here at 3.3 if we take a look at the chart going back months. Next news story, AMD reports third quarter 2021 financial results. These were fantastic. AMD today announced revenue for the third quarter of $4.3 billion, operating income of $948 million, net income of $923 million, diluted EPS of 75 cents. On a non-GAAP basis, operating income was $1.1 billion, net income $893 million, diluted earnings per share was 73 cents. If you go through the AMD earnings report, every single metric was better than expected, and it was fantastic. The company's cutting costs, the company's saving money, the company's revenues are up, their net incomes are up, and their growth was across the board on all of their products. Computing and graphics segment revenue was $2.4 billion, up 44% year on year and 7% quarter on quarter. These increases were driven by higher Ryzen, Radeon, and AMD Instinct processor sales. For the enterprise, embedded, and semi-custom segment revenue was $1.9 billion, up 69% year over year. 69%? Nice. And 20% quarter on quarter. Here we could see all of the different news. We've covered a lot of this on the channel, but new partnerships, new awards, that type of thing. Here's the really exciting stuff. Their current fourth quarter outlook. For the fourth quarter 2021, AMD expects revenue to be approximately $4.5 billion plus or minus 100 mil, an increase of approximately 39% year on year and another 4% quarter on quarter. The year on year increase is expected to be driven by growth across all businesses, all aspects of the company. For the full year, AMD now expects revenue to grow approximately 65%, driven by growth across all businesses, up from prior guidance of 60% growth. So there you have it. It's fantastic. All of the numbers out of AMD are just stellar, and they raised their guidance for Q4. And a lot of times on these earnings reports, it's the future guidance that people are looking for. These stocks are trading well into the future. So with the fourth quarter guidance increasing, AMD's share price raised as well. AMD chart right after the earnings, it ended up kind of just running up super high. We hit 128 a share, pulled back the 2 days since, but this really shows what people do feel the company is worth, and we are expecting more growth out of AMD. Just the numbers on their earnings reports are stellar every single time. Next news story, just a reminder that there are other semiconductor companies. Intel's Core i5 12600K CPU is up to 50% faster than Ryzen 5 5600X, blows away the Rocket Lake Core i9 11900K flagship in leaked benchmarks. After their last earnings report, they did drop off substantially. The next day, it was a 12% dip, but this really just kind of provides another buying opportunity for Intel. This is an incredibly profitable company. Yeah, they have a huge float, 4.06 billion shares outstanding, 4.05 billion for the float, but the company pays out a great dividend, 2.84%. It's a semiconductor processor, it's a tech company, and the PE ratios for Intel are pretty solid here. We're coming in at about 9.27, so it's definitely not an overvalued company when you compare it to its competitors. Last I looked, AMD's PE is somewhere around 30 and Nvidia's PE is somewhere around 90, so Intel coming in here at about 9. This really shows a lot of value, but if you're investing in Intel, you're investing into the success of the processor industry and the success of the foundry in the future, because chip-wise, it seems like they're really on the struggle bus. Next news story, this one might be the funniest of the week. Facebook changes its company name to Meta. Facebook is rebranding itself as creating the Metaverse, and a lot of people are saying that Facebook is rebranding itself to take attention away from all of the negative press that Facebook's been getting lately with the whistleblowers that we reported on a couple weeks back, with just the degenerate aspects of social media. So instead, we're going to create the entire Metaverse. There's going to be VR and AR, and everybody's going to be interacting with avatars. And this is all going to happen in 10 years' time. I don't know about you, I'm still waiting on my flying cars before I get excited for anything involving a metaverse. The name change, which was announced at the Facebook Connect Augmented and Virtual Reality Conference, reflects the company's growing ambitions beyond social media. The rebranding also comes after the company has dealt with a barrage of news reports over the last months stemming from whistleblower Frances Haugen's trove of internal documents. Here's a great picture of the lizard person showing off some of the virtual reality goggles. Today, we are seen as a social media company, but in in our DNA, we are a company that builds technology to connect people, and the metaverse is the next frontier, just like social networking when we got started, said the Zuck. The stock ticker is going to be changing from FB to MVRS effective on December 1st. And if you're wondering where they're going with this, our hope is that within the next decade, the metaverse will reach 1 billion people, host hundreds of billions of dollars of digital commerce, and support jobs for millions of creators and developers. Here's the thing though, the company also said this week it'd spend about $10 billion over the next year developing the technologies required for building the metaverse. And this is why I don't want to shit on the metaverse too hard, because Facebook has the financial assets at its disposal to do basically whatever it wants. Remember, Facebook, no matter what you think of the company, is cash rich. They are flush with money. They make an incredible net income, and they can use that money to do whatever they damn well please. So if they want to create an entire metaverse ecosystem and the technology used to access that, well, they can. The funniest thing about this entire article is actually the last little sentence this add in. In a call with analysts on Monday, Zuckerberg vehemently refuted the claims and critiques in the reports stemming from the documents provided by Haugen. I don't really know what you can refute. They're internal documents. It's not like the lady forged all of them or altered all of them. She has thousands of internal documents. Like, what are you refuting? Oh no, those aren't really internal documents. That's not the truth. We just send lies back and forth to each other. I don't know how you could possibly refute anything that the lady has. It's all pretty damning. Facebook's been on a bit of a downtrend since 384. The whistleblower release on that 60 Minutes report by Frances Haugen ended up hitting the company pretty hard. And even after a decent earnings report, we're still kind of just flatlined. But the VR AR announcement did lead to we've had a 3.5% increase in price this week towards the end of the week. Next news story, Robinhood shares tank as revenue falls way short of expectations on lighter crypto trading. Oh, Robinhood shares tanked. Darn, the company's struggling. Couldn't have happened to a nicer company. Third quarter transaction-based revenue totaled $267 million, with only $51 million coming from cryptocurrency trading. Revenue from crypto trading totaled $233 million in the second quarter. It's like everybody finally realized, not your wallet, not your coins. Robinhood said that, barring any change in the market environment, the headwinds that dragged down the last quarter will persist into the end of the year. So, bad future guidance, bad earnings report, stock tanked. For the third quarter, total net revenue came in at $365 million, missing the estimate of $431.5 million. Revenues increased 35% year over year, but were well below the second quarter's revenue of $565 million, which was bolstered by a massive surge in crypto trading. They're saying that Q2 was one of those idiosyncratic market events where there's this massive interest specifically in Dogecoin, and those are hard to predict. Oh, poor baby. This is a big one. Average revenue per user decreased by 36% to $65 year over year from $102. And they ended up reporting a net loss of $1.32 billion or $2.06 per share. Wall Street was expecting a loss of $1.37 per share. Whew. Okay, so they lost way more than expected. Yikes, that doesn't look good at all for Robinhood, and I'm not surprised. A lot of people have simply been leaving the platform and going to better platforms like Fidelity, TD Ameritrade. Heck, Webull. I love Webull. I use it every single video. I think it's great for trading. They're partnered with me. Shameless plug. But seriously, Robinhood is a pile of steaming crap, and they make money, but they don't make enough money to offset their advertising costs, and yeah, that's it's just bad right now. Here's Robinhood's weird price chart. You could see back when they IPO'd at the end of July, rose all the way up to $85 and then have lost just all that value. We're back down to the IPO price. IPO day, we opened at $38, and we're actually below that right now, $35.13 after hours, and this was just a disastrous earnings report for the company. The next news story I have for you guys isn't necessarily a news story, but it is a statistic from JP Morgan that really shows the value of investing, the importance of investing your money and not just letting it sit in the bank. Anytime I talk to my friends who aren't necessarily investors, I always do push for them to put the money that they don't need, money that they can do without, into an investing account, into a trading account, and just invest into some broad market ETFs at the very least, because when it's just sitting in the bank, especially in these low interest rate environments, it's not doing anything. And historically, before the last year, inflation was holding pretty strong at about 2% per year. year. So if you had your money sitting in the bank, you would need to be getting a return of over 2% just to be beating inflation, which means effectively that your money is just sitting in place and it's not doing anything. And a lot of people really just don't understand that by having money in the bank, okay, yeah, it's good. It makes you feel safe. Maybe you feel like you're being successful, but it's not growing. And I thought this chart was phenomenal as far as showing visually the importance of investing and the importance of the inflation threshold. The title here is Savings Accounts Ain't What They Used to Be, and the data comes from Bankrate.com, FactSet, Federal Reserve, JP Morgan, and US Global Investors. So we have 4 different indications on the chart. The dark blue lines are your income generated by a savings. And if we go back to 1994, you were generating more income over your savings compared to inflation. So you're actually making money by keeping your money in the bank. But then after the dot-com bubble, that dropped off substantially and savings interest values were much, much lower than inflation. They peaked back up, but then they have not been the same after the great financial crisis. This is over a lost decade at this point, going back to 2009, where if you've been keeping your money in a savings account, you've been losing interest to inflation. This is astounding. Take a look right now, 2021. So for income earned on $100,000 in a savings account, you would need $3,977 to beat inflation. However, income generating by a savings account this year is only $70 on $100,000 in the account. That's dumb. Even income needed to beat medical care inflation would be $373. So you can't even beat medical care inflation with that $70. The income needed to beat education inflation, currently it's about $1,380. So you can't do anything. You are actually actively losing money if your money is just sitting in a savings account. That's all I have to say about that. If you don't know anything about stocks, anything about trading, just invest into VTI. Just a broad market, everything included, ETF, and you're going to beat your savings account. That's all there is. If you or a loved one are still using a savings account for your excess money, please get help. Reach out to somebody. Next news story, the US agrees to roll back European steel and aluminum tariffs. The deal, which comes as the US and EU allies met in Rome, will keep some trade protections in place in a nod to metalworking unions that supported President Biden. So back in 2018, President Trump put into place some import-export tariffs that were very, very heavy on most countries in the world, but notably the EU, and it was a very America-first approach. He was attempting to keep American and manufacturing very insular so that America would benefit from its own labor. Now, any economist will tell you we do benefit from global trade. So these tariffs, I think in the short term, they were a good thing, but in the long term, they have to change because countries do benefit. Everybody does get wealthier. The production possibilities frontier gets expanded outward through international trade as companies are able to do that which they specialize in. I don't give the Biden administration a lot of credit for a lot of the things they do, mostly because I think that a lot of what they're doing is just trying to undo what Trump did, and I think that that type of politics is very nitpicky and crazy, in the same way that a lot of Trump's policies just tried to undo what President Obama did. It seems like all of these politicians just waste time trying to undo whatever the politician before them did, and it's just a headache, and I hate politics with every single fiber of my being. But Biden's not going to be rolling back all of the tariffs, and instead they're going to be placed on a different tiered system that is pretty clever depending on the volume leading to the tiers, which we don't know the details yet. But this is going to stop the EU from putting forth retaliatory retail tariffs that were going to be increasing by severity by a large percent on December 1st. And this is going to affect a lot of large American global brands like Harley-Davidson, like Caterpillar, like some of our food producers, that type of thing. The agreement will put an end to the retaliatory tariffs that the EU had imposed on American products, including orange juice, bourbon, and motorcycles. It will also avert additional tariffs on American products that were set to go into effect on December 1st. We fully expect this agreement will provide relief in the supply chain and drive down cost increases as we lift the 25% tariffs and increase volume. The deal marks the final step for the Biden administration in dismantling Mr. Trump's transatlantic trade war. Under the new terms, the EU will be allowed to ship 3.3 million metric tons of steel annually into the United States duty-free, while any volume above that would be subject to a 25% tariff. So they're still going to get to ship some steel into the US duty-free, but with transportation costs being as high as they they are right now, and the EU facing the energy crisis that it is right now, I don't actually see this affecting American steel at all. This is just going to be a news cycle hiccup, and it's not going to be a long-standing thing. 3.3 million metric tons of steel is a lot, but the US steel makers can still produce more than that, and the 25% tariff is still going to be in place on any volume past that. So this is going to be just kind of giving the facade of flexibility, but given the current global situation, I would be surprised if that 3.3 million metric tons ever even makes it into the United States. Cleveland-Cliffs ended up releasing a comment on this situation. Today's announcement of an alternative Section 232 measure with the EU is evidence that President Biden and his administration understand the critical role of the steel Section 232 program in providing a level playing field for American companies and workers. This tariff rate quota arrangement will guard against a harmful surge of steel imports from the EU. So there you have it. It's not just my opinion, but even Lorenzo Gonsalves of Cleveland-Cliffs says the same thing, that the tariff rate quota system is going to stop the steel from coming in at a price below what could be competitive for American manufacturers. So this really should not impact the American manufacturing significantly, although, like I said, we still haven't seen the full volume numbers for the tariff rate quota beyond that 3.3 million metric tons. Now, one of the things that was taken off the retaliatory retail tariff section was orange juice, American orange juice. And this is really, really funny. As soon as this announcement was made, you could see orange juice futures. Yes, orange juice futures are a thing and people trade these. They ended up shooting up $2. So hooray, orange juice futures. I know, orange juice futures, that's kind of a meme, that's kind of a joke, because like Coca-Cola owns most of the orange juice companies, so this is barely going to affect Coca-Cola's share prices. Whatever. Anyway, I think one of the companies that's going to be benefiting from this most strongly is going to be Harley-Davidson, ticker HOG. And Harley-Davidson is one of those like world recognized American brands. It's a legacy brand, you know, some of the most expensive bikes in the world. I'm not a big Harley-Davidson fan, and I'm actually not going to be investing in them from this point. However, I can understand why people would be making this investment. Harley-Davidson just released their earnings report last week, and this came out on October 28th. They beat their earnings estimates, and they actually raised their 2021 outlook. This was made with the knowledge that the December 1st retail retaliatory tariffs from the EU could still go into effect, and those tariffs would have increased the tax rate on Harley-Davidsons in Europe by 56%, which would have made them completely uncompetitive in the market. If you go to the transcript for their earnings call and you just search tariff, everything that they talked about with the tariffs on October 28th, again, before the Biden administration and the EU came to the deal there, was talking about the negative impact to the EU's tariffs. And in fact, throughout their earnings report, they were adjusting to exclude the impact of the EU tariffs. It goes on and on through their earnings report where they're talking about the negative impacts of these tariffs, and you could go through and look at the unit volume sales declines just from the initial tariffs that were put into place since 2018, and how it's kind of created this negative perception of the company throughout Europe as being unnecessarily expensive. But now the EU's lifting those tariffs, the worst tariffs aren't going to be in place, and Harley-Davidson had been financially successful over the last year, beating their earnings expectations for consecutive quarters, and now they're going to have this huge headwind because these tariffs have actually been lifted. All of their previous forecasting was going under the assumption that they were still going to have to deal with the tariffs. So suddenly they're going to be releasing new forecasting data. I don't know when, but here within the next couple weeks, I imagine, that's going to be showing higher guidance, and we should see a surge in share price for Harley-Davidson. Here's what I'm talking about. We had 1, 2, 3, 4 consecutive quarters of beats on the earnings. This one, the animation's not drawn in, but it was a beat. This is the one that was just released this week. And if we take a look at the Harley-Davidson chart and scroll out, you know, we hit a high of about $52 in May, and since then it's just been on a path straight downward. There was a nice spike after the earnings because the last earnings report was so positive, and we've declined. Right now we're sitting after market at $36.49. I'm going to tell you, on Monday morning at the open of trading, there's going to be a surge here for Harley-Davidson as this news slowly gets disseminated through the markets and people realize that, hey, we're basically at a bottom here for Harley-Davidson and things are going to be looking up and the company is going to be releasing improved guidance. Now, like I said, I'm not going to be opening a position in Harley-Davidson, mostly because I'm happy enough with my exposure and my portfolio to consumer cyclicals, and I don't feel the need to add Harley-Davidson, which is another luxury good, in an environment where we're already dealing with inflation. But I can understand why people would want to do this. The chart looks very appealing, the earnings reports are very appealing, and we know there's going to be increased guidance coming out because of the lifting of these tariffs. So for anybody that's out there, take a look, do some of the research for yourself, but you'll see what I'm saying is basically right here. Let's take a look at the upcoming earnings for this week. We've got a lot of kind of smaller companies that are going to be reporting this week. You know, some ones that people are going to be a little bit excited about. We've got Corsair. That one's got a huge following online. Roku and Skills as well. A lot of people are interested. We've got a lot of people that are Viacom holders. I see a lot of chatter about that one online. Square, I think, is just one of the best payment processors going forward that you could possibly invest in. Phenomenal company. Uber, trash. Airbnb, not really so bullish on right now. A lot of energy companies going all the way through. We've got Etsy, and I'm kind of a little nervous for Etsy after seeing some of the other online sellers last week. Some of the energy providers, we have ConocoPhillips, we have Marathon, Apache, Dominion. Those are going to be a little bit interesting to see. We've got Peloton. Their sales have really come back down to earth. A lot of negative news for them. A couple of gold sellers here with Barrick and Sandstorm. Gold has really been struggling. I wonder if the Fed, with the whole tapering situation, if this is actually going to finally lead to an increase in gold. A couple other companies I'm excited to see. I like Chegg. I think it's a little bit overvalued, but still, it's a pretty interesting company. Zillow Group, same thing. Discovery Communications, I think, is actually severely undervalued here, and we're going to be moving into some big changes with that company going forward. I've already covered several of them on the channel. And one that I'm actually quite interested in is coming in on Thursday before open, Himax. Himax is a Taiwanese semiconductor company that, like, it seems nobody knows about, but when people talk about Taiwan, they only talk about TSMC, and nobody talks about Himax. Himax has been around forever, and I actually have a lot of very positive things that I've found about Himax, and I want to share them, but I'm going to do another video for that one, and I'll be releasing that video shortly after this video. But if you want to check out that video and see why I think Himax is actually a good play this week on earnings, then, you know, you might want to, I don't know, check that one out. All right, everybody, that's it for me today. I hope you did enjoy the video. As always, if you want to support the channel, please check out my Webull referral link below the video. If you sign up for an account, deposit $100, you get a free stock, I get a free stock, everybody wins. Also, if you enjoyed the video today, please like the video, subscribe to the channel, and if you want to be alerted to all my content as soon as it goes live, make sure you hit that notification bell. All right, everybody, thanks a lot. Stay safe, good luck investing, and I'll see you next time.